Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo. We do not have Mr. Alex Collins today as he is at a conference, but we have a guest that has been on the show a couple times and that we wanted to bring back by the name of Rob Bukacek. Rob, welcome back.
Yeah, for those trying to adjust their monitor, I am not Alex Collins.
So, before we dive in, right, today's episode is going to be around estate planning, and Rob has been on to discuss, different mistakes. That's episode 274, and he's also he had an episode, episode 281, where it's traversing the estate plan. Today, we're going to get into really kind of a sample client, if you will, and going through an estate plan and the different documents and where the money flows to and how it flows. So we're going to get into that today. But before we dive into that, Rob, I know you're not the biggest beer drinker.
I'm not.
So you've got your monster drink. I've been watching The House of Guinness, by the way. Have you been watching this on Netflix, by the way?
Great show.
Dude.
Absolutely great show.
So I was at the store. I saw Guinness. I'm like, I got to get me a Guinness. And what's even funnier is, like, true story. I'm watching, I think it was the first episode where it's going through and it's getting into reading the will.
Yeah.
For the sons. And I'm like, oh, I got to get Bukacek back on the show.
I was like, oh, away we go. Like, and that's a pretty standard episode, or not episode, but situation where nobody's happy.
Yeah. So we're not supposed to be talking about like specific estate plans, but the House of Guinness, that show specifically, if you haven't watched that show, definitely go check it out. It's an interesting, even from a financial planning standpoint, of how that will broke out and true stuff happens in family, even though that was, I think, in the 1800s is when that time frame is. That stuff still happens today, just maybe in a different type of setting.
Yeah. And even back then, Dad was thinking ahead, right?
Exactly.
And putting stuff into his will that, he knew was going to be an issue once he was gone. So handled it.
So let's dive into this, Rob. So we were, at a high level, we're going to be talking about a sample client. A lot of people that listen to this show, they tend to be in the tech world. They're working for the Amazons, the Facebooks, the Googles. And so they typically have a higher net wealth. And, I live out in Seattle. You live in California, so you're used to it. Oregon's kind of the same way, like this whole West Coast. Like, housing isn't cheap.
Mm-mm.
Right? So once you put your house into your estate, which is included in most people's estates, you've got a decent net worth. And so the simple client that we're talking about right now has got, call it a $4 million estate.
Okay.
And the question is, okay, they've got kids, right? And let's just say they've got kids in like junior high or high school.
Sure.
But they're setting themselves up for, obviously, if, the two spouses pass away at the same time, but also bigger picture here around, how to make sure that their nest egg gets to who they want it to, when they want it to, how they want it to, and under what circumstance.
Yeah. Yeah. And, when we draft an estate plan, we kind of do it based on what we know today, what we think might happen. I mean, you got teenage kids or even, in grade school that you don't know how they're going to turn out. You don't know if they're going to be, independently wealthy themselves, or if they're going to be struggling, if they're going to have addictions. Right. So there's all things to kind of consider about what if, and you can draw all these things into your estate plan to say, I'm going to put language into my estate plan just in case this is the scenario that happens when I die. Like, my kid's in a bad marriage, or they've got an addiction problem, or they've got a spending problem, right? They're just not good with money. So I want to make sure that I protect them from themselves. So
I'm constantly learning from you. Like, we were at a conference back in March, right? The Living Balance Sheet conference that we were at. And I'm sitting there and we're listening to Eileen, who is an estate planning guru, just like yourself. And she brings up the fact that, my daughter is about to be 18. And she brings up the fact that, well, if your kid gets married and then happens to get divorced, if you haven't set your plan up appropriately, do you want your daughter's or your child's ex-spouse to get any of that money. And like right away, for me personally, that was a hell no. And I had to go in. I'm pulling up my estate plan documents in front of you for you to read it to make sure I've got it set up. And I didn't have it set up the way that I wanted. So I had to come back and I had to redo
Hmm.
our trust to make sure it was set up so the trust would not go away.
Yeah. And you just do you do an amendment, right? Sometimes it's just an amendment. Sometimes it's been a while since you've actually done your trust, and maybe some of the rules have changed. Maybe there's new concepts or strategies that can be implemented into a state plan that, weren't thought about 5 years ago when you did your trust. So in that case, you might do an entire restatement.
Yeah. So I bring that up from the standpoint of we're constantly learning and to help our clients, and I'm learning personally, right? So I'd love for you. You've got this diagram that you walk your clients through. I'd love for you to walk through that diagram here. I know many of our clients or people that are listening to our show, they're listening, they're not seeing this visually. I highly encourage you to check out our YouTube channel. We'll put the YouTube channel in the show notes so that you can see the visual side of this, because I do think going through this diagram really helps our clients see how this works.
Yeah. So let's see if I can get that centered. Okay. There we go. I don't want to give away the end. So we'll scroll up a little bit. But so this is a conversation that I take all my clients through, whether they're worth $100,000 or $100 million, right? Um, and it's basically just to give them an idea about the basic concepts of how an estate plan can work, the different options, what the different terminology is, the different roles that people play inside their trust. And so I start with just kind of like this simple diagram while, using an example of a husband and a wife. Um, and they've got an estate and they want to put together an estate plan, or they already have an estate plan and I'm basically telling them what they have in place, like I did for you, right?
Right.
So when I'm talking to clients, first thing I talk about is when you establish a revocable living trust, an RLT, right? You're basically just creating an entity that owns your stuff, and you control it. You decide what goes in it, what comes out of it, and you benefit from it. So while you're alive, you are holding a couple of different roles, wearing a couple of different hats. You are what's called the grantor or the settler. I've also seen trusts that say you're the trust maker, right? So different names, but basically the person who's creating the trust. The attorney's drafting it, but it's your creation. And then you're also the trustee. You're in charge of it. You decide what goes in, what comes out. And you're also the beneficiary, right? And now it seems confusing. It's like, well, wait a minute, my kids are the beneficiary of my trust. No, you are the beneficiary of your assets while you're alive, or even alive and incapacitated. You're still the beneficiary. And your trust is basically created to own your stuff. It'll own things like your investment account. It'll own your house. It could own your business if you have a business. It will also own things like stocks and bonds or brokerage accounts, your checking and savings accounts, and it can own life insurance policies. There's some strategies to do with that too, but that's not for this conversation. We can do that later.
And Rob, real quick, I don't mean to interrupt you there. Maybe you're about to go there. The purpose of having this revocable living trust is bypassing probate.
Correct, right? So having all these assets inside this entity allows you to direct who's in control of your assets, whether you're alive and alive and incapacitated, or when you've passed away, who's gonna control it. And it avoids probate because you don't need the courts to go ahead and oversee it. You've basically said, look, I'm not going to go through that process. I'm going to have this individual be in charge, or these individuals be in charge, or this entity be in charge of distributing my assets or overseeing my assets for my heirs. So yeah, you avoid the cost, publicity, and expense, or delay
Yeah,
of
gotcha.
probate. Because depending on what state you're in, like I'm in California, it's about 2 years to get through probate. And
Washington's a little bit easier from what I gather. That being said, I don't, me personally, I don't want all of my personal stuff and information out there. I kind of
yeah,
like it being secured. So,
I
all
don't
right,
blame.
I interrupt you. Keep going.
That's okay. So, there are things your trust won't own, and it won't own things like retirement accounts, pensions, uh, business plans, simple IRAs, things like that. Those have to be owned by an individual. It can be owned by the trust after you've passed away, but um, not while you're alive. It needs to be owned by you. So we avoid probate by naming beneficiaries to those things, and then the beneficiary process avoids the probate. So you've established a trust, and now, while you and your spouse are alive, you're just kind of doing things. It's really no different than how you own things now. It just your checking account, your checks say the trust of, um, the Revocable Living Trust of the Smith family or Smith Family Trust or whatever, and you just sign your name.
Yep.
Nothing really changes. How you want your assets to be directed once you've passed away, there are a few different options. Most people say, give everything to my spouse, the surviving spouse. Okay. And all those assets would go into what's called a survivor's trust. It's not a new document. It's the same document. It's just got a new understanding of what it is. This is the survivor of this couple, and that person now owns 100% of the assets. Pretty easy.
Yep.
Problem with that option is that the survivor, especially for a young family, a surviving spouse might remarry. They might go back into the market and say, hey, I got a few years left in me. They meet somebody, and that person, everybody's heard of blended families, right? That person might have their own children. And the problem with having everything go to the survivor's trust is that the survivor has the ability to make changes to that document in the event their life changes or their ideas changes. So the person that's passed away no longer has any say. And some people don't like that. Some people
Yep.
say, hey, if I die, I don't want my half of the assets that I built over my lifetime to go to somebody other than my spouse or my kids. So what they can do is they can change that option and say, you know what, I'm not going to give them 100%. Now we're 50-50 in this deal. So 50%, hope everybody can read my chicken scratch. 50% will go to my surviving spouse. And then we have what's called the B trust or a credit shelter trust, to where I can direct the 50% of my assets to go to that trust. So my 50% goes to an irrevocable credit shelter trust. The other 50%, that was my spouse's. They get to keep it. They can continue to give it to my kids or do whatever they want to do with it. And the cool thing is that now when my spouse passes away, it's written. The words that I wrote down before I died, that the assets in the credit shelter trust, my half of the assets, go to whoever I directed them to go to before I passed away. And until, and even after, depending on how you have it situated, until that second spouse dies, these assets are protected from creditors. They're protected from a divorcing spouse. So if my spouse remarries, that person doesn't have any claim. California is a community property state.
So is Washington.
Okay. So in a community property state, a divorcing spouse has access to assets or has a claim. Not in this case. Nothing in the credit shelter trust is accessible to a divorcing spouse. And then financial imprudence. So if my spouse just doesn't know how to spend money, they're incapable of saving, they're incapable of understanding how to budget, I can make sure these assets are in here so that they don't get to invest or spend just willy nilly. And then these assets are available under what's called the ascertainable standard. And the ascertainable standard is health, education, maintenance, and support. So, health, education, maintenance, health and education, pretty simple. Maintenance, support, a little vague, but basically the idea is that my surviving spouse can get to these assets in the credit shelter trusts only for basic necessities, right? And only after they've spent all their own money.
Would basic necessities qualify as just like what their lifestyle that they're accustomed to?
Yeah, so they're driving around in uh I don't know, a Toyota Corolla, and they want a new car. Well, maybe they can move over to a Honda Accord, or maybe even like a base model Mercedes. But they can't go out and buy a Ferrari. They can't buy a Lamborghini, right? They can't
Yeah,
spend $100,000 on a car when they spent 20 the first time.
I think a lot of people when they're seeing this, I mean, maybe when they're hearing this too, like the initial thought is, well, wait a minute. So my spouse will only get 50% access to the money, and then the other 50% sitting in this other trust, this credit shelter trust. So like, am I hindering my the spouse that I just passed away? Am I hindering my spouse financially speaking? And you're really not, because again, they get to keep pace with the lifestyle that they're accustomed to, and the other 50% in this example that we're sharing, they can do whatever the heck they want with.
Yeah. Well, and it can go the other way too. So, imagine a couple is in, they're retired, and one spouse dies, the other spouse has all the assets, and we've heard the story. They hit the gas pedal instead of the brake.
Yep.
They mow down a sidewalk full of people, and now they get sued for everything that they own. Well, what's not accessible is anything in that credit shelter trust.
Yep.
Just absolutely. So it's not exposed to lawsuits. Now, people like the IRS, like, if the deceased spouse, did some fraudulent activity, or even the surviving spouse did some fraudulent activity, and the IRS might be able to get in there. But for the most part, it's pretty bomb proof.
And then
Okay,
tying in, like, sorry to,
that's okay.
uh, tying in the state estate tax. Like in Washington, we have a state estate tax that most of my clients either don't know or they forget about it, and because I think they in the media, all you hear is the federal number, and
Yes.
so it's a much bigger number. And so, because that's what they hear about, they just forget about the Washington state estate tax, not understanding that a lot of my clients will have this issue if it's not addressed, or at least, have a tax possibility. And so, like in Washington, I think they just raised it. I think it's a 3 million per spouse is the Washington state exemption. So how does
Yeah.
that come into play with what you're discussing right now?
So if you've got like your example was a $4 million estate, right? That's basically 2 million to the survivor, 2 million into the trust in this example.
Yeah, and well, just real quick as well, another reminder to people: life insurance will come into play when it comes to the estate tax,
Hmm.
right? So they might just be thinking their assets, not thinking the life insurance. If there is 4 million of assets, but they have 4 million of life insurance, that's an $8 million estate.
Yeah. Well, I mean, what do we always hear? That life insurance is income tax free, right?
Yep,
Totally true. But it's not estate tax free.
it may not be estate tax free exactly.
Yeah. So, you throw in a couple extra $1 million of life insurance, and, it, yay, you got a couple extra $1 million. But if you're banging against that $15 million estate tax exemption next year, or even just the $3 million estate tax exemption of the state that you're in,
Yep.
then yeah, that gets tricky. So, um, and I have a solution around that too, but we'll talk about that on another episode. As far as what to do with the life insurance policies.
Yeah.
But anyways, using my example, or using your example of $4 million estate, you got $2 million going to each box, the AB trust. And by the way, that's kind of a common term for this type of arrangement, an AB trust. So if an attorney says, "Oh, you have an AB trust," or "Do you have an AB trust?" That's what you have. If it's automatic, If it's the option to create it at the first death, like the surviving spouse says, I may want to do that, I may not want to do that, that's known as a disclaimer trust. So the surviving spouse actually has to disclaim the property to create the credit shelter trust. But anyways, in Washington there, you got $3 million state estate tax exemption, right? Now, we're only using 2 million of it, right? So we're good because we have this set up. So that $2 million gets to move into that credit shelter trust applied. They had a $3 million state tax exemption. As I understand it, the extra million doesn't you don't get a credit for the
No,
surviving spouse to apply to theirs. So, if they hit the lottery or something like that, sorry, you can't use the million of your deceased partner that they didn't use. But that scenario would take care of the 2 million. If we just had my original example where 100% went to the survivor, and now in that example, you've got, say, $4 million over here, plus life insurance, and then that person passes away with only a $3 million exemption, they're paying state estate tax
which I think a lot
on
of
that.
people in the state of Washington have that. They don't understand that they're skipping their spouse's exemption because of how they have it set up.
Correct. And like you said, at the beginning of the show, like, you know, you have a house, like you're well on your way to that exemption amount. So,
Yep.
um, yeah. And people are probably looking at the C trust over here, and the C kind of comes into play a couple different ways. So this is more for federal estate tax that the C trust gets set up. And the federal estate tax, back when it was in 1990, I think it was $600,000 was the exemption. So you could pass on $600,000, and then they increased it, ramped it up for a little bit year after year, and then there was also the Portability Act. So a surviving spouse, if they did not use their spouse's federal exemption, could elect portability on the 706 tax return, which is the death tax return, and basically pocket that person's exemption for later use when they die
Yep.
and add it to their. Uh, Now, if they remarry, they lose the old one, they get the new one, or they get the new one. I can't remember it actually. I'm gonna have to check. I think they can only keep one. I don't think they get the new spouse. I can't remember. Anyways, off the top of my head. But anyways, so using the strategy, using the C trust, we can move assets into the C trust and use what's called the unlimited marital deduction for federal estate tax purpose, and transfer an unlimited amount to the surviving spouse in trust. Still all the same requirements. It's still for health, education, maintenance, support. It's still for credit protected from creditors and divorcing spouses, and you elect portability, and then you pocket that person's exemption. And then when the second person dies, they've got their own exemption, whatever it is in the year that they die, plus the exemption of the deceased spouse. So upon the death of the second spouse, everything in this C trust comes flying over here into the A trust, and then they apply their own personal federal estate tax exemption, and if they elected portability, whatever they had left over from their spouse.
Gotcha. So I know you got a time constraint here. With the last 3 minutes, if we can jump to, so we just kind of discussed where the money flows between spouses. Now let's play the game of, okay, the second spouse passes away and now it's going to the children. Walk us through that.
So, second spouse passes away, everything that's in the survivor's trust and the credit shelter trust usually says, give it to my kids equally, right? Same thing with the survivor's trust, split it up equally. It can be in a single trust, It can be split between two trusts, or however many kids you have. You got 10 kids, you could create 10 separate trusts if you want. Sometimes it just doesn't make sense to do that because of accounting and everything. Um, and basically, you can set it so that your children continue to have these assets held in trust for the rest of their lifetime. They can access it for that ascertainable standard, HEMS, health, education, maintenance, support. They can invest in it. They can buy homes in it. And then if they get divorced, or if they get sued, or they're just bad with money and they get knee deep in debt, creditors cannot come after that money. Lawsuits cannot attack that money. It's protected. Divorcing spouses cannot get that money. So that money stays in there. A lot of people, a lot of trusts say, you know what? I trust my kids. Let's give them a third when they're, let's say 20 years old. And then we can give them another third when they're, say, 25. And then we can give them the balance at, say, age 30. And the idea there is like, okay, at 20, they might be good with money. They might not. We don't know. Let's let them practice. And then at 25, they might be a little wiser, or they might just be just as terrible. So we'll give them another third, hope they do well with it. And then at 30, by golly, if they don't have it and they don't have it right, then, oh, well, I did my best. All right. Problem with that is that at 20, a third of those assets could be exposed to a divorcing spouse. At 25, another third, right? I mean, if I'm looking at my spouse like, yeah, I don't like you, I'm going to leave you, I'm waiting until they get that money before I say I want a divorce.
Which now we're getting to like the aha moment that I had, because I did your third aspect, and it hit me. I was like, you know what? And I think we were taking it out to age like 45 actually. So we had a little bit longer runway, I guess. But for me, and again, I'm just speaking for me personally, it became an issue of, I really want this money to be, I don't want it to be money that they just go waste necessarily. And I also don't want it to be money that their ex-spouse can somehow get. And so I want it protected from that. And I want, with the values and everything that we're building inside of our family and what I think is important to us, I want to be carried forward. And
Yeah.
that was a big part, which is where the trust came into play. And so we had to change the language to match that.
Yeah. It's as a parent, you have access to your kid's cell phone, right? To make sure you put parental controls on there, and then they start driving, you put a GPS on their on their car, or maybe you just follow their phone. Right? What do you do when you're not here?
Yep.
And they get everything. They got all this responsibility. They got all access to all this money and property and everything like that. And you want to be able to protect them. And
Yep.
this is the way to put that that tracker
You nailed it, dude.
on their money.
Yeah. Well, as always, man, I always appreciate you coming on. For our listeners, definitely check out the YouTube channel and the show notes. We've got an Instagram channel out there as well, so it's under Ryan Burklo Finance. We'll put that link out there. If you got anything out of this, anything that bubbled up, you're like, man, I hadn't thought about that. Share this episode, right? Because we want this information to get out there. The whole reason we started this podcast was to help you think differently about your money, and in this case, help your money go where it wants to go under the values and stipulations that you've got for you and your family. Rob, appreciate you, man. Thank you again.
Love being here, Ryan.
Bye, bud.
Thanks for having me.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
Rob Bukacek is a registered representative and financial advisor of Park Avenue Securities and financial representative of Guardian, CA Insurance License Number 0D63943. 8473790.1, expiration October 2027.